In this video, we talk fixed rate versus variable rate. Stay tuned. What's up, everybody? It's Rob Campbell, the mortgage broker from the Rob Campbell Mortgage team. If you haven't already done so, go ahead and subscribe to the channel down below and click that little notification bell. If you click that bell, you'll get notified every time we upload new content, and you'll be able to watch that at your own pace. So as we discussed at the beginning of this video, we're talking today about fixed rate versus variable rate mortgages. This is a question that still comes up to this day. Even with historically low fixed rate mortgages, people are still asking the question about, should I take a variable or should I take a fixed rate mortgage? Also, before I forget, go ahead and smash that like button. It'll help us climb that YouTube algorithm. Anyway, here we go. So as stated before, fixed versus variable, what is the best option? Before we dive into which is best at this current time in November of 2020, let's talk a little bit about the differences between the fixed rate versus the variable rate. First, we'll start with fixed rate mortgages. A fixed rate mortgage is a set rate for a set term. So as you sign your mortgage contract, whether that's for a 3-year term or a 5-year term or even a 10-year term, your interest rate and your payments are locked and loaded for that set term as per the original agreement. Now, as noted, there are set terms that differ from each other in mortgage wonderland. We generally see people go right to the de facto 5-year fixed rate mortgage. And that is the case because historically people have always been sold that as a product because it gives them security over 5 years. But truth be told, there are other terms that you can take. You could take a 1-year, a 2-year, a 3-year, heck, even a 7 or a 10-year fixed rate mortgage. And those rates would be different based on the current pricing on those mortgages at the time of origination or the time that you're taking that mortgage. So why would you want to take a shorter term over a longer term? Well, maybe your individual plan or your goal for the property and the mortgage doesn't need to be 5 years and it doesn't need to be 10 years. Maybe you just want to lock in that low rate for 1 or 2 or 3 years to leave you with some options at renewal or potentially selling the property. If you take a longer term mortgage, like a 10-year fixed rate mortgage here in Canada, you run into the risk of having to trigger a penalty if you want to break that early. Now in Canada, 10-year fixed rate mortgages, if you broke it 3 years down the road or 4 years down the road, you'd be subject to a penalty based on the remaining amount of years in that term, unless you go past the 5-year and 1 day mark in that 10-year mortgage or even the 7-year mortgage. In Canada, a lender can only charge a 3 months interest penalty on a term once it's past the 5-year mark if it is a 7 or a 10-year mortgage. So a lot of people want to hedge their bets over a longer term, but the caution there is you don't really know what life's going to bring, and you might want to break that mortgage for whatever reason and not be faced with a huge penalty to do so. Now, speaking of the 10-year fixed mortgage, historically, it hasn't been worth a homeowner to take the 10-year fixed if they were able to compound one 5-year term over another 5-year term with the way that rates have been over these last 5 to 10 years. Rates are exceptionally low, and historically speaking, the math just doesn't add up if you did take the 10-year versus 2 5-year terms back to back. But again, in an increasing rate market where the economy's booming and taking off, it might be a great strategy to consider that 10-year fixed rate mortgage. Anyway, now we'll get to variable rate mortgages. So as we dive into variable rate mortgages, there are 2 types of a variable rate mortgage that we need to learn about and understand. One is an adjustable rate mortgage, and the second is a variable rate mortgage. Now, both of these are not created equal, although they are based off of the same pricing model. So a variable rate mortgage and an adjustable rate mortgage are both based off of the prime lending rate of Canada. And the prime lending rate of Canada is a rate that's set by the Bank of Canada upon multiple meetings throughout the year. Hey, as a sidebar, if you want to learn more about the overnight lending rate, you can just click up here and you'll be able to watch a video that we shot on that overnight lending rate in the past. There'll also be a link at the end of this video, so just stay tuned for that. So the variable rate mortgage is a fantastic product for people who are okay with having a little bit of risk of rates going up, but also understanding that at any time in the term, you can convert that mortgage or lock it in, as it were, to a fixed rate mortgage. Now, a word of caution here, depending on which lender your variable or adjustable rate mortgage is with, you might have to set that term into a 5-year fixed or greater. So just be cautious when shopping for converting that variable over to a fixed rate mortgage. You want to make sure that at the onset of origination, you're with a lender that allows you to take maybe a shorter term remaining in your contractual obligation with them. Now, what are the differences between a variable rate mortgage and an adjustable rate mortgage? Remember, those two things are different than a fixed rate mortgage. Okay, a fixed rate mortgage, as we've already noted, is a set interest rate for the term of your mortgage. But a variable and an adjustable rate mortgage are both based off of the prime lending rate of Canada, as I've already mentioned, but they're both priced a little differently when it comes to your monthly obligation. So let's talk about the variable rate mortgage. Okay, so this product is priced on a month-to-month basis when you're outputting your monthly payment or biweekly payment. It's priced on prime moving up or down, and it has a set fixed price per month that you're paying. The only difference with that is as rates go up or down, the proportion of interest to principal will adjust accordingly with every payment. Okay, so if prime goes down or goes up, your monthly obligation is going to stay the exact same. So if you're outputting $2,000 a month, that's going to stay the same. But the amount of principal and the amount of interest you're paying with every mortgage payment will fluctuate depending on which way that rate has gone. Okay, so it's a real secure way of having a monthly obligation. Just know that as that payment gets diced up, when rates go up and down, diced up into principal and interest, those are going to fluctuate based on which way the rate has gone. And if rates do go too far up, you could run into a situation where you're outputting more interest than principal, and it might need to adjust that payment per month, but your lending institution will notify you of that. So now let's talk about an adjustable rate mortgage. So this mortgage has a fluctuating monthly payment based on rates. Unlike the other product, this will have a set payment at the time of closing, whether you're buying or refinancing or renewing your mortgage. Your monthly payment will be set at a certain amount, but as prime goes up or goes down, your monthly payment will also go up or down. So it will keep the proportion of principal and interest in line, but it will move your payment up or down based on the prime lending rate of Canada. So just be cautious of knowing which product you're getting into and understanding how that's going to affect your amortization should rates go up, because it's going to impact the remaining years in your amortization if the payment doesn't adjust accordingly. Okay, so those are very important features that you need to understand when shopping for your mortgage with a bank or mortgage broker. So let's get back to what's the best product to take today at the end of 2020. Really what we have to look at is where the economy is going. We've just somewhat wrapped up an election south of the border where it appears that Joe Biden's won the election. Now, there are some voter fraud speculations that are going to be investigated, which, as a sidebar, has happened in the past with investigations in earlier elections. So it's not typically uncommon for this to happen. But how that's going to impact the economy is still set to unravel, and we're at the end of a pandemic as well. So that definitely has its pros and cons on what is going to happen with the markets. I will say this: in Canada, it appears that we're facing a bit of an economic stall. COVID-19 doesn't seem to be wrapping up anytime soon, and there still seems to be some potential fallout with how the economy is going to fare up against the past 8 months that we've had and moving forward as well. So the Bank of Canada, interestingly enough, which sets the overnight lending rate, again, click up above or at the end of this video to learn more about that overnight lending rate. The Bank of Canada sets that overnight lending rate, and the Bank of Canada has come out in the last week or two and reiterated that they will not be touching interest rates until 2023. So we're now wrapping up 2020. That's 3 years away potentially before the Bank of Canada even thinks about moving prime lending rates. So you have to ask yourself, are you better off taking the variable or adjustable rate mortgage knowing that that rate's not going to potentially move for 3 years, or should you just lock into a fixed rate today and take your chances on whether or not rates would go up or down? Here's what I'm going to say. I think at this current time, and again, this is for information purposes only and educational purposes only, every buyer's unique, every homeowner's unique, so I would definitely recommend that you consult with a banker or broker about this, or me. I would say that at this current time, the variable rate mortgage would be a better option over a 5-year fixed rate mortgage for 2 reasons. The first reason is you could generally find a slightly lower variable rate at this moment than a fixed rate mortgage. And second, you're almost guaranteed to only trigger a 3 months interest penalty should you want to break that mortgage and pay it out before it matures. And that's a really powerful thing to understand, because generally speaking, when you take a fixed rate mortgage, you are looking at a higher penalty to break that fixed rate mortgages, just by ways of where the shorter term rates end up. Now, if you want a fixed rate mortgage and you want the security of a fixed payment, seriously consider taking a shorter term mortgage. Don't always default to that 5-year fixed mortgage. You might be able to find some great promotional 2-year fixed rate mortgages or even 3-year fixed rate mortgages out there in Mortgage Wonderland, and be able to keep your options open for the next 2 to 3 years as far as where rates might go, and also limit any loss that you might trigger with a penalty to break should you want to break that mortgage and to refinance or to even sell the property. So generally speaking, I'm a huge fan of the variable rate mortgage right now, the variable interest rate based on prime. Whether or not you take a variable or an adjustable rate mortgage is a whole different conversation. But each one of those has their own benefits, obviously, and knowing which lender that you're going to go with is also equally important because of that fine print. Well, I hope you found this valuable. I know that this is a question that comes up a lot, and hopefully this has brought you a little bit of clarity on the matter. Fixed versus variable rate mortgages in Canada are continually being a topic of discussion, and I hope that this has laid out some good information for you to make a more educated decision in the future. Again, if you haven't done so, please go ahead and subscribe to the channel. Click that notification bell. You'll get notified when we upload more content. If you have any comments, please leave them below. Let me know your thoughts. Would you prefer a variable rate mortgage or a fixed rate mortgage based on the information you've heard here today, or even the thoughts that you might have on the economy moving forward? Again, always review your options and think about the plan and the goal moving forward, not just for the property, but for you, for life, what part of life you're in, what age you're in, career changes, retirement. All these things definitely play into your decisions with mortgage financing. I'm Rob Campbell. I'm a mortgage broker here in Canada. I hope you found this useful. Also, give us a thumbs up on this video if you think that it's been useful to you and mildly entertaining. Hope to see you again on the channel soon. Take care for now. Bye-bye.